Hello and welcome to the Jake and Gino Podcast. With me today is Zach Haptonstall. He's the CEO and co-founder of Rise 48 Equity, which provides multifamily investment opportunities for accredited and non-accredited investors to protect and to grow their wealth. Since 2019, Rise 48 Equity has completed over $2 billion in total transactions. Welcome to the show, Zach.
Yeah, no, thanks so much, Gino. Really excited to be here, man. And I'll tell you, in 2018, about 6 years ago, when I was trying to get into this space, and I knew nothing, I knew nobody. Your podcast was one of the first podcasts I listened to, and it was honestly inspirational. And I felt like a connection with you guys, even though you didn't know who I was. So before I ever had a deal, I was listening to you guys. So it's pretty cool now to be on your show. So thanks for having me on. Really appreciate it.
Zach, it's my pleasure. And I got to ask, what was the difference between our podcast and everyone else's podcast out there?
Yeah, I like the fact that, first of all, I think that the fact that there's two of you guys, and you could tell that the cool thing that I realized between the two of you is that you guys were business partners. You had complementary skill sets, but you also genuinely liked each other. And I could tell by like the banter back and forth. And I could tell that you guys had kind of carved out roles in the business, and you could just kind of sense it, based on your conversations. And when I was getting going, I was so discouraged and overwhelmed with how hard it was and how the components that I did not have, like the weaknesses that I had that were needed to operate. And I realized I need to find my complementary, Jake, so to speak, which I found my guy in Bikram, my partner. So I think it was just a cool thing that you guys were like honest. You had started kind of with your own money, before you started to syndicate, and you kind of like the dynamic of the two of you. So that was kind of the cool thing that I liked, to be honest with you.
The listeners missed our little banter back and forth before we hit the record button. And it was important. I typically don't get fired up. I typically don't use F-bombs, but I had to with Zach because being an entrepreneur is lonely. And that's what I think that's what you're talking about, Zach. Jake and I are real. It's an amazing business. Making money can be fun, but it can also be soul-sucking. I mean, you can get accused of so many things that you haven't done, or there's so many things that can be misconstrued. And to have a Vikram and to have a Jake there by your side is so important. But before we get into that, I'm usually known as the one who likes to slow play this, and Jake's the snowplower. So I'm going to try to slow play this right now because I want to get the listeners to know, Zach, from 2018, you're starting, and now you got $2 billion. I mean, why multifamily? And what was your background before you got into multifamily?
Yeah, of course, Gino. And so, I'll kind of give a quick background so we can kind of get into some other stuff that we want to talk about here. I know we were talking about before we started recording. So I was born and raised in Phoenix, Arizona. Just grew up in like a lower middle class family. My dad worked for like a construction company, painting, exterior building. Mom worked in HR. So I was just a regular guy. No, rich uncle or real estate connections. I was taught, go to school, get good grades, get a degree, get a good job. And so, I got a journalism. I first played, Division II college football. Realized I wasn't going to go to the NFL, so then I wanted to be a sports reporter. Got a journalism degree, was a live news anchor, sports reporter in Arizona PBS, and that was cool at first. And then I quickly realized this isn't what I thought it would be. When it's in your full-time job, it's not as cool as being a fan, okay? And you don't really make any money. And I had all this student debt, and so this sucks. I need to make money. Like I want to be financially free. I don't want to be paycheck to paycheck doing something I thought I would like. And so while I was going to school, I was delivering medical equipment nights and weekends to pay for school. And I realized I don't want to go into journalism. Okay. So after I graduated, I was like, I need to make money. I went into healthcare marketing, working for a hospice company. And so over, 6 years or so, I went from a marketer, director of marketing, became president and co-owner of a hospice company, got my MBA. By the time I was 23, Gino, I was making like $150K a year, more than money than both my parents combined. I bought a house. I went to night school to get my MBA, paid all that off. So, I was fortunate, by the time I was like 26, 27, I had no debt besides my mortgage. I was making $200K plus a year, but I was honestly miserable because I was just grinding constantly, doing something I wasn't really passionate about. And so I was like, man, I got to do something to create passive income or something. I didn't know anything about real estate. I just wanted to kind of create passive income, kind of that cliche, type of saying. So in January 2018, I resigned, sold my equity in that company, and I had no plan. I had almost $300K of cash, which I had relentlessly saved over the years, following like the Dave Ramsey plan, been getting a little pop from selling that equity. And I didn't know anything about multifamily or syndication when I quit the job. I was actually thinking about flipping houses, believe it or not. And so I'm just like, how do I make money through real estate? So that's when I started listening to podcasts, and I found you guys. I started reading books, going to meetups. And I first was looking at mobile home parks, and I cold called like 90 mobile home park owners in Phoenix. I was trying to buy one on a seller carry with my own cash, and, hardly anybody answered the phone. I couldn't make it work. Then I started to learn about the whole concept of syndication. And that's where it clicked for me, because the whole time I was trying to think, how can I take this 300K and like launch it like a missile, like to go big? Like, how can I make it go as far as I can possibly go? And I just realized that it's not that much money for me to go by myself. But when I realized I can go and leverage my time and energy to help other people put their money to work, and I can get sweat equity and exponentially make more money through my energy and my time, that's what really excited me. And I was looking at mobile home parks, self-storage. I initially looked at multifamily, Gino, and I was discouraged because I felt like it was too competitive and saturated. And I was like, oh, I missed the boat on multifamily. I got to go to the next thing where there's not as much competition. And then I realized, okay, cap rates in mobile home parks are compressed. Self-storage is tough. And I realized, okay, if it's a good investment and people are getting successful, it's going to be competitive. That's what I realized. So you cannot stray away from competition. You got to go with, what do you think is best? And so multifamily, when I realized, was that, first of all, I felt like it was easier to sell to investors, than other asset classes. And I also like the fact that I could add value. We could renovate units to push appreciation, get that margin. That made sense to me. And then I like the fact that, to me, it seemed like there was no ceiling on where you could scale that type of business, right? Like, there's no ceiling. You could buy more apartments in Blackstone theoretically. So that's why I liked it. So long story short, lived off the savings. It took 14 months to buy the first deal. So I was burning through cash. I met my two business partners at a conference, and just kind of quote unquote dating a lot of people, or business partners, trying to find the right group. We closed the first deal in February of 19. It was a 36 unit, $3.5 million deal. We just put our own cash in that deal, found a couple other people. So we weren't able to syndicate it. And then we started syndicating from there and just kind of gained momentum. And we're really fortunate to sell deals, keep cranking. Since then, we started a property management company, started a construction management company. We have over 240 plus full-time W-2 employees on full benefits. We added a second market. So we've been fortunate, to kind of build out the infrastructure, but that's kind of how we got to this point.
That is awesome. There's a few things I need to mention. The first thing, I wish Jake was on this podcast, because he would say, there's another person who is following his passion. Jake loved to work out, so he wanted to be like a personal trainer. But when you go to the gym, you'd be like, these people don't want to work out. I don't want to be a babysitter. I'm trying to work my passion, and my passion is not making me money. Become passionate at something that you're getting good at. Zach is passionate about multifamily, not because of bricks and mortars and tenants. He's passionate about it because he's kicking ass in it. And the better he gets at it, the more passionate he's going to get at it. And it becomes a vicious cycle. So don't tell me you want to become a restaurant owner because you love to cook. I will promise you that was the wrong way to go, because I was down that path also. There's a few other things I really need to mention. The grass is greener on the other side. There's a shiny object syndrome. Well, mobile home parks are great. Yeah, go buy a mobile home park and try to pitch that to people when the median income is $28,000 and you're trying to. It's a great niche if you know what you're doing.
Yeah,
but multifamily to me.
Yeah.
I mean that's important. I think a couple other things. I'd like to ask you this question, but your partners, you'd said before you hit the record button, hey, Jake and Gino, they get along really well as far as partners being friendly. How did you find your partners? Do you have any tips on what to look for in a partner?
Yeah, good question, Gino. So like the biggest thing that I realized when it was getting going, I was like, man, I need like somebody who knows construction, and I need a balance sheet guy, because my net worth is literally my cash. And I was like, I can't sign on these loans with 300K net worth and liquidity. And I needed an elite finance guy. Okay. So I have an MBA. I took some accounting classes, but I'm not a finance guy. I literally hate sitting in front of an Excel spreadsheet. It drives me crazy. And I underwrote like the first 30, 40 deals, and I want to pull my hair out, and so I don't like to do it. I'm not good at it. So I was like, I need like a CPA. I need like an elite finance guy. And I was like meeting different people at conferences I was going to, meetups. And it's like some guys you meet, they don't want to work as hard as you. And when I say meet and try to partner, like, hey, you want to work on deals together in Phoenix? Okay, let's start getting on calls, underwrite deals together. Let's make offers. And some guys don't work as hard as you. There was one guy who was actually pretty successful, but I realized he was just trying to use me, for my time and energy, didn't want to do anything. One guy, we had a nightly call for 2 months. We were getting along really well, hard worker, great guy. But I finally realized, I was like, hey, man, we have the exact same skill set. Okay. I need a finance guy. Like, I'm not helping you. You're not helping me. So I cut him. I said, we're not going to work together. And so, anyways, it was kind of, through trial and error. So, Robert, I first met, and Robert had a construction background, and he had like net worth liquidity of like a few $1,000,000. I was like, okay, this is my balance sheet guy, and this is my construction guy. Because I looked at myself, Gino, as I have no experience raising money. I've never done this. I need to be kind of like the general manager of the team. Okay, I need to put the team together and be the architect, right? And I have to identify what are my strengths and what am I good at, which I thought were just pure hustle, building relationships, raising money, managing relationships, and leadership when we started to hire staff because of my healthcare background of managing people. And then my weaknesses were I need like a true finance guy to help underwrite. So then I met Bikram, and Bikram is like my perfect complementary partner in not only skill set and pedigree, but in personality. Right. And so he's got a CPA economics degree. He was a corporate auditor at one of the big 4 accounting firms. So elite with underwriting. Bikram loves to underwrite. He would rather sit in front of a spreadsheet instead of talk to people. And I'm very like, type A, kind of alpha, go, go, go. And Bikram, elite work ethic, will outwork anybody, but he's very, more of like a submissive or passive personality. Right. Mm-hmm. So he's kind of like the voice of reason, when I'm going intense, and we kind of balance each other out. And so, I think that you have to have that, because you're going to go through any business, right? You're going to go through some stuff. You're going to go through tough times. And like you just said, you said it best, Gino, that you have Jake and Jake, and you guys have each other's back, right? Through the adversity. And I couldn't do this without Bikram, because not only when you're getting started, it's tough and you need another person to kind of just keep you going, hold you accountable. But then when you go through tough times, like the last 18 months have been the toughest time of my life, going through these interest rate hikes and, what's been going on with the economy. And we've just had to battle through the adversity, and it's holding each other accountable and keep pushing. So, those business partners aren't easy to find. And I tell people it's like dating. You're not going to always find them in the first time, but you need to identify what are your strengths, what are your weaknesses, and then you need to find somebody to fill in your weaknesses. And that's how you can kind of go next level.
Zach, when you started looking into multifamily, what were the key differences, or what didn't you know that you thought you knew? Because I think that, to me, there's 2 key differences in multifamily and residential. It's the financing aspect of it, between the amortizations and the terms, and it's really the broker relationship, the MLS, finding deals versus, you don't have an MLS on multifamily. What did you learn that you can share with the listeners out there that are wanting to get into it and saying, just be careful, this is a big difference?
Yeah, no, I think there's a lot of stuff, but you mentioned 2 good points I'll touch on, Gino. And so I would say the broker relationships, these are like politics, okay? And there's like literally, so we're in Phoenix and Dallas, 2 of the biggest markets in the country. And there's literally 5 or 6 individuals, brokers, who control 90% of the inventory. And if you are not in with these guys, you won't scale, because you're not going to see the deals. And even if you want to bid on them, it's an unfair game. Okay. So it's all about the relationship. You have to gain credibility, build track record. And once you do that, then you can gain that competitive advantage. Okay. So like the first 4 deals that we bought were on the market. We had to go through best and final. We had to prove that we could perform, not retrade the seller, meaning.
But you still did that, though. Like, let's everyone be clear, because you can be listening to this and going, "Oh, Zach's got $2 billion. I can't compete with him." Well, Zach had to suck it up, Buttercup, to do the first 3 or 4 deals, like Jake and Gino. We found deals online, and then after that, we built a little community, a little bit of branding, and then that went a long way. But don't be discouraged by saying, "Hey, Zach, there's only 5 or 6 people that we need to know." You're going to start like everybody else in the beginning, but you got to put in your reps, and you have to become credible and have to do the work. I'm sorry, I didn't mean to cut you off, but I don't want anyone to think that, well, I can't compete because he's finding all the deals. That's just pure horse crap.
And you're right, Gino. And now's the perfect time to do it. If you're trying to break in, it is the perfect window, because there is no competition. Okay. And I have a lot of guys I talk to that reach out to me, at least once a month, saying, "Hey, can you give me some tips?" And I always try to help them. And I introduce them to brokers. I said, you got to go for it. And so, to put this bluntly, okay, is that you just got to have the balls to go for it, because you're going to be going after a deal, and you're going to be experiencing so many things that you've never experienced. And you are going to feel intense anxiety and stress, and you have to keep pushing through it and find a way. Okay. And at the time, it's not like this in this window right now for a lot of deals, but at the time when we were getting going, it was the expectation. You are going non-refundable with your earnest money day one. Okay. So like our first deal, we were fortunate to get like a 30-day due diligence, but I went 25K hard and Robert went 25K hard after 30 days, and we didn't have any of the money raised. But I said, let's just keep going. It's kind of like burn the ships behind you. Now we got this pressure. We're going to find a way to do it. While I was in escrow, Gino, for that first deal, I put all my money in the first deal. So I literally had like 165K left. I put 160 into it. So I knew I was going to be out of money. And I was like, I need earnest money to buy a new deal. I'm trying to scale. So I literally sold my house while I was in escrow for the first deal. And when I sold the house, I got 120K from it. And the next week I wired $100,000 non-refundable day one into a new deal that we won. And I'm not saying you have to, go intense or go crazy like that, but these are the things I realized that if I want to gain a competitive advantage, you have to understand these broker relationships. They're very sensitive. And I was intimidated by these brokers because it's like, everybody's like, don't screw the broker over. You get blacklisted, don't retrade them. And so you have to be very sensitive with them. And then you had to be aggressive on your earnest money and your terms. And so understanding the broker dynamics, but you can start to gain momentum. So like, for example, we became a pretty big buyer in Phoenix, and end of 22, we wanted to expand to Dallas. So what I did is I called all the guys in Phoenix. I said, hey, we're going to Dallas. Can you introduce me to your top guy in Dallas? And it's all the same firms, right? CBRE, Marks Millichap, Northmark, Berkadia, JLL. So they endorsed us. And I go into Dallas, I meet all the top guys, and immediately getting off market deal flow. Mm-hmm. Okay. So so as another example, we just decided we're going to enter Charlotte, North Carolina. Okay, just made that decision a couple weeks ago. So I'm going out there next week for an entire week, and I'm meeting the top 5 or 6 guys. I've already set up meetings with them because I called the Phoenix guys and the Dallas guys, and they endorsed to say, hey, these guys can close. And so it just goes to show you that, like any business, it's relationships, right? So it's all about your reputation, your track record. And to source deals, you have to build those relationships. I mean, we can go on and on, debt, all these other topics too, Gino, but there's a lot of stuff. There's dynamics here that are different in the multifamily arena.
There's a few things that I need to touch on. I think the first thing is you don't have to start with a 150 unit deal. Zach started with a 36 unit deal. Jake and I started with a 25 unit deal. Bite off as much as you can comfortably chew. I think that's important because everyone says go big or go home. Cash is trash, all these stupid things that you hear that in reality make no sense. If you need to start with a duplex, start with the freaking duplex, because then once you start, you'll figure it out. Then you'll buy a 10 unit and you're like, well, 10 units is not that complicated. Let me go to a 30 unit. And then a 30 unit becomes a 60 unit. Then all of a sudden you've got some refi money coming in and you know how to sell or finance, and you've got a list of 30 investors. So don't be on the sidelines waiting for that to happen. And what you said is so accurate. The brokers need us now. And it's okay to have a concession of that dirty word retrade. It's not like it was 3 years ago. Understanding the market cycle, where we are in the market cycle. And it's important to learn these things because that market cycle will come back. The seller's market cycle will come back with a vengeance like it did. But right now, if you're thinking about getting into multifamily or any real estate, you have a little bit of an advantage because the brokers, there's not a lot of deal flow. A lot of people are sitting on the sidelines and they need to talk to Zachs and Ginos and Marys and Johns because they need to sell. So it's important right now that if you're thinking about it, now is the opportune time to get into the market. I'd like to hear your comments on that because that to me is truly important to get that message out to people.
100%, Gino. The dynamics have completely changed where as a buyer, you have all the leverage. It used to be, I used to constantly call brokers and they would not answer my calls. They wouldn't back me. Now I'm too busy. I'm missing brokers' calls. Like I literally have 2 texts, a couple of brokers in Dallas. They texted me last week. I haven't gotten back to them. And I don't feel bad because there's no other buyer. It just is what it is. I'll get back to them. So yeah, the dynamics have completely changed. You can go refundable earnest money now. That is pretty common. There's hardly any competition. And it's like, if any of you are on LinkedIn, you've probably seen 100 people over last year do that cliche quote from Warren Buffett, when everybody's greedy, be fearful, when everybody's fearful, be greedy. Everybody wants to post that and think they're cool, but nobody does it. Okay. Now is the time when you should be going after deals. And so at the end of 22, we felt like it just kind of hit me. I was like, we have this golden window because Dallas is so hard to enter. It's very competitive. And I was like, now is our moment to enter the Dallas market because all the institutions on the sidelines, the syndicators are afraid they can't raise money or they can't raise money. We got to pound it and enter it. So in 2023, we were the number 1 buyer in Dallas, Fort Worth in the country, about 8 deals, over 2,000 units. And the reason we're going to enter Charlotte right now is because Charlotte has always been a very competitive institutional market. And we feel like now is a good time to enter the market and get that foundation. Because like you said, Gino, once those interest rates do start to cut, the institutions are now going to see, okay, this is our baseline. We'll adjust the underwriting, and there will be capital that will flow back into the market. Cap rates will compress, and things can flip very quickly. And so, I think I also like what you said, because when I first started, I was so focused on I have to buy 100+ unit deal. Economies of scale. If it's not 100 units, it doesn't support an on-site staff member. Bigger is better. And I wasted several months with that mindset because I couldn't even get a broker's attention. They're not going to give you a 100-unit deal if you've never bought a deal, and you're not going to be able to raise the money most likely. And so I tell people, buy the first deal at all costs, and it does not matter the size of it. And I don't, when I say at all costs, obviously you don't overpay. You make sure it's a good deal, but you need to just do what it takes to get the first deal, because you will learn so much through the process. You will get a lot of confidence and momentum from your experience that allows you to keep rolling it. And like you said, Gino, the reason we were able to scale is because by the time we were buying deals 5 and 6, we were selling deals first and
Yes.
deals 2. So all of a sudden, so I made no money the first 3 years. Okay, 2018, 2019, 2020, we owned 4 deals. Actually, we owned 6 deals, 60 million, and I was like $12,000 in credit card debt because I put all my money in the deals. I had to go back and get a job. I went back into hospice. People don't realize that. And so, but at right around the same time, end of 2020, we sold the first deal. I get flush with cash. I start really getting off-market deal flow from brokers because we've proven out the concept. And then we started charging acquisition fees, which is more common. So we took all that revenue and profits and we started to build infrastructure, and we started hiring staff and reinvesting in the company. And then we started selling deals, doing 1031s. You start getting more investor referrals. So it is this snowball effect. But I had to start out just like anybody with no experience, no contacts. And even a 36 unit was probably pretty big. You could start, like you said, buy a duplex, buy a 5 unit, because you're going to learn a lot, and then you can just keep rolling from there.
So what Zach is telling everybody, don't be buying Bitcoin at 68,000. You should have bought it at 20,000 6 months ago.
2 weeks ago, yeah, exactly.
It's so insane that it just constantly repeats itself and repeats itself. And God bless all of you that are buying Bitcoin at 20,000. I think you're doing great. I still see it as a speculative play. I can't make sense of it. And the thing is, it's so addicting. I'm looking at the phone all the time. I'm up like 20% on my crypto, and it's just like, do I sell? Do I sell? Whereas what we're doing, if we're buying these assets for the long term, we can't exit. We have to really make really intelligent decisions. And by the way, all those guys that are buying Bitcoin and crypto, they need to do something with their tax liabilities. So who do they go to? They go to a Zach and a Jake and Gino from Multifamily. So it's great when you're making money in crypto, but come on over to the dark side of multifamily, and there has been dark side over the last 18 months. Let's transition into that. Sure. What's gone on in the last 18 months in the market for you? Because, before you mention or preface anything, Jake and I have had probably the best 18 months of our career in multifamily, because in 2021 and 2022, we didn't buy a lot of deals. We saw a lot of deals. We didn't want to go into bridge debt. We have buy right, manage right, and finance right. But in 2023, we bought 350 units, nice. All our own capital. Really amazing deals. And for us, it was challenging in 21 and 22 to make deals pencil. Now, you're an amazing market. Your market's constantly growing, Phoenix. The rent's been going up. Population's been amazing. But what have you seen over the last 18 months for yourself and for the average multifamily investor?
Yeah, absolutely. Absolutely, Gino. So I'll kind of talk to you guys about the operational side of existing assets and also the acquisition side, right? Because we've been busy on both fronts, and it's basically paying offense and defense, if you want to look at it that way. And so basically, as many of you know, right now, Gino and I are recording this in March of 2024. So 24 months ago, March of 2022, the Fed began, a historically aggressive interest rate hike where they did 11 consecutive hikes. It was the fastest and most aggressive interest rate hike in over 40 years, since the 1980s. Okay. And none of the institutions saw it coming. Nobody really projected that this would happen. And so what happened across the country, with a lot of private equity firms, is that the bulk of value add multifamily, which was really purchased by, private equity firms are the biggest buyer, but also a lot of syndication groups, was purchased with floating bridge debt, floating interest rate bridge debt. Okay. And so basically what happened is that even if you bought a cap, most people were buying interest rate caps, 5.5 to 6.5%, because it didn't make sense at the time to buy caps down, in like the low threes or 4%, because nobody saw the forward looking interest rate curve projecting that. And so what happened is, in literally within a matter of months, interest rates shoot up and a lot of deals go into negative cash flow. Okay. So I can tell you, like in the second half of 2021, we bought 11 deals and we put 3-year interest rate caps on all of our deals. Okay. Which is kind of unique. A lot of people put 1 or 2-year caps. And by the way, we've done 10-year Freddie Mac fixed rate debt in the past. We've done 10-year Freddie Mac floating rate debt, and we've done bridge debt with floating rate. And so we know the pros, and we've sold all types of those products. We've sold 11 deals, all types of products. So we know the pros and the cons upon acquisition through operations and disposition. And the reason we do this floating rate debt is because we have little to no prepay penalty, which allows us to maximize returns on the back end. And so basically I'm buying caps, where my max cap is between 5.5%, 6.5%. We're buying deals where when we buy them, the interest rate is low threes. In our model, we're assuming interest rates will increase at least 1 to 2%, 100 to 200 basis points in the first 2 years. So we did build interest rate expansion into the model, which was more conservative than what like Chatham Financial and these forward-looking curves were projecting. And we thought we were good. Well, within a matter of months after buying these deals, interest rates skyrocket. My rate goes from low threes up to 5.5, 6.5%. My debt service doubles, and these deals go into negative cash flow like immediately, right? Meaning that the debt service and the operating expenses are higher than the income the property is producing. And this has happened, across the country for anybody who had floating rate debt. And so what's happened is the last 18, 24 months, you've seen a ton of groups do capital calls, which means that they're asking for investors to put out more money because the property ran out of liquidity. Now, we've never done a capital call, and we don't plan on doing any capital calls. And I'll kind of explain, how we've avoided that. And so basically, Q3 of 2022, we're like, okay, the writing's on the wall here with the Fed doing these aggressive interest rate hikes. We need to fight back. Okay. I'm not going to just sit back and, keep my occupancy high, pray that interest rates come down. We got to fight back against the interest rates. And the way that we did that was to increase the velocity of our renovations, crank our renovations even more to increase rents, increase NOI. Okay. And so basically in 2023 alone, we renovated 1,923 units, almost 2,000 units.
Wow.
So we were
good for you.
Yeah. So we were forcing vacancy in order to renovate faster and then push the rent. So to give you an idea, we've got our own property management company, our own construction company, and then we control our supply chain. We buy all materials directly wholesale. So we went from renovating, 30 to 50 units a month to at our peak, 200 to 250 units a month. So we're cranking these units out. So in 2023, renovated 1,923 units. Our average rental increase was $453 a unit, which was $23 or $20 over our initial projected rents. And while this was happening, Gino, what happened across the country, especially in Phoenix, is that there was all this new supply of new apartments hitting the market. Okay. There was a ton of building that happened between 2018 and 2021. And I saw this according to RealPage, 2023, there was more new supply of apartment buildings that hit the market in the United States than any other year since 1985. So we had like this tough time where I'm forcing vacancy on purpose to be able to renovate these units, because you can't renovate if people are in there. So I'm forcing vacancy to renovate. At the same time, there's this flood of new supply hitting the market in 2023. And what happens when you have all this new supply, and at the same time, the COVID stimulus money ran out, which was like kind of artificially propping up a lot of these tenants' incomes. And inflation had really caught up to people, like their average daily living costs of groceries, gas, et cetera. So in Phoenix, we saw a big softening in the market. There was a negative 4% organic rent growth in Phoenix in 2023. Negative. Rents were going backwards. So here I am forcing vacancy to crank renovations in order to push my net operating income. And even with negative organic rent growth, we were getting $450 rental increases across almost 2,000 units by renovating and forcing appreciation. So for us, it was kind of a proof of concept that the reason we do value add is that we are not vulnerable or relying on organic rent growth. We are forcing appreciation. So we've now gotten the majority of those deals back to positive cash flow just by renovating units, haven't done a capital call. And we've been communicating with all of our lenders, and our lenders are like, they're literally calling us. Like there's a guy, He's the president of a publicly traded REIT. And he literally told me, no BS. He's like, we have over 100 multifamily loans and you guys are doing the best job because you're actually executing the business plan. Most people, they want to preserve liquidity to pay the debt service. But, these lenders have been like, hey, you guys are renovating, you're doing what you're supposed to. We've already negotiated 2 loan modifications. One of them, we got a fixed rate loan that they converted it to. Another lender extended us out because they're like, hey, we didn't see the interest rates skyrocketing either. But at least you guys you're hitting your CapEx budget, you're hitting your pro forma rents. And so that's what's kind of happened there, Gino. Then go ahead.
What would you have done differently? Would you have done something differently back in 21 or 2022 if you'd known that rates were going to go up?
Yep, I would have. And I'll tell you what I did because we started doing this in second half of 22. Okay, so after that second interest rate hike in May of 2022, we said, okay, the writing's on the wall. We need to adjust our underwriting to adapt to these higher interest rate hikes. So what we started doing in May of 22, we started buying lower interest rate caps. So we were making sure that our interest rate cap was at like 4.75 or 5% day one, and that there was significant positive cash flow day one when we bought the deal. Okay, so we're making sure that we're buying lower, tighter caps. Because in hindsight, our biggest mistake, Gino, was the delta between where I bought my interest rate cap and where the current rate was. So for all the new deals that we started underwriting, and this was reflected in September of 22 onwards, almost 18 months now, all those deals, we bought a cap where our interest rate is 4.75 to 5% day one, and there's significant positive cash flow. We raised more cash reserves, and we ensured that by the end of year 3, when my cap expires, my NOI, my DSCR, my debt yield are high enough to be able to refinance into an agency loan, even if interest rates have not come down from where they are now. So like the last 13 deals that we've purchased, those deals are all positively cash flowing. They're distributing every month, and we're now increasing distributions as we enter year 2. And so yeah, basically we had to adapt our model, and we had to adapt our operational infrastructure, Gino, to be able to renovate that many units. We had to hire, I don't know, at least 20 or 30 construction guys. And we turned flipped that switch on. Okay. And as a props to our team to be able to do that. So we were able to kind of navigate that and make sure that we can, modify our operations. So that's on the operational front. On the acquisition front, like I said, we saw this big opportunity, to enter the new market. And so we've had significant growth. We entered Dallas last year. We have over 50 full-time employees in Dallas, Fort Worth now. I go to Dallas at least once or twice a month. And now we see opportunity in Charlotte. And so I think, when you can show your existing base transparency, you can show them, hey, this is the strategy and this is why it makes sense, then, they believe in it. If you can get the results, and we've had a lot of repeat investors that are investing in these new deals. And so that's kind of the dynamics we've seen, the last 18, 24 months.
That's awesome. Let's take a quick time out to hear from our sponsor.
Now, we have had a great run in multifamily, going from 0 units to over $250 million in assets. That's over 2,000 apartment deals that we've been able to purchase through our framework: buy right, manage right, and finance right.
Now, Jake and I, we created the Jake and Gino community back in 2015. We launched our first book, Build Our Profits. And since then, our students have closed over 60,000 units. That's over $4 billion in assets they've been able to close over the last 6 years.
And that's why this community has been so successful. We call it results-based education, and we pour back into the community everything that we've learned on our journey from 0 to 2,000 units, and all our systems and scale that we use on our very own property management and investing companies.
Jake, I love that. It's not just education, it's implementation. So what I want you to do, click on that link down below, apply to work with our team, see how we can help you on your journey in multifamily.
And we're back. Now, Zach, I have a theory on why people did not know rates were going to jump so quickly. And my theory is that news is all fake. When you have certain news outlets that you lump together, Jake and Gino, with other groups in our education company, and they don't talk about the veracity, the truth of the article, and they put in accusations and they don't follow up with their homework, and people think that that's actual news. I think that's what's going on, and that's what's harmed the economy. I mean, it's happened to you as well. If you want to address anything that's happened to you, I don't want to name any publications, but when you go out there, it's all clickbait. And it's very hard for investors to get the truth about what's really going on. Because if you're investing and you're saying to me that inflation is transitory and your boots on the ground, your labor's going up and everything's going up, and you believe that because these news outlets are telling you, I mean, what are your thoughts on that?
Yeah, no, I agree with 100%, Gino. I mean, I think your firm and our company has both been lumped into articles with, blatant inaccuracies. And I've pushed back on stuff publicly. And it's just funny. It's like, if you look back at it, so to give people some context, I graduated from the Walter Cronkite Journalism School, right? Which is considered like the number one school. It's like Walter Cronkite at ASU and Syracuse are like the top two journalism schools each year in the country. And so I graduated with what I think are true journalistic standards. And we learned about journalistic ethics, objectivism, things like that, objectivity rather. And if you look at it, and I won't get too political here, but ever since President Trump became president in 2016, it seemed like a lot of things shifted. And what I learned in journalism school, which was prior to that, there's literally a handful of organizations that control the majority of mass communication. And so what you've started to see is that when you have mainstream media, there are narratives that can be shifted. And it seems like the accountability and the standards of journalism have been eroding, over the years, because there's no accountability. And this could apply to any aspect in life, right? There's constantly reports that later are proven to be untrue, but we're so busy now with all these channels of mass communication hitting us. We have social media, we have Instagram, Facebook, TikTok, Twitter, everything, that we forget the news cycle is so short and people don't care anymore. It's just about the journalists just want to get the headline because that's what they're going to get a bonus or whatever. They're going to get their ratings. And then if it was wrong or inaccurate, people will forget. It doesn't matter. And what I've learned, you want to apply that back to real estate, what we're talking about here, is that we cannot rely on the media or a lot of these sources that we used to trust, because people were saying, hey, the interest rates aren't going up. Chatham Financial is like the golden standard of financial projections. And, the smartest people in the world were shocked. The Goldman Sachs, the Blackstones, they didn't see it coming because they're getting caught by a lot of this stuff. And a good example, Gino, is you and I are recording this right now in March of 24, right? Every single time Jerome Powell has a Fed meeting, we're all hanging on his every word, right? And it literally impacts the markets. It impacts the 10-year treasury. And just in December of 2023, he basically said that interest rates are going to cut. We're going to start cutting interest rates in 2024. Everybody was shocked that he was that positive or optimistic because he had been, had this very, rigid stance throughout the year. And literally within 24 hours of him saying that in December, the 10-year treasury dropped 30 basis points, right? Well, then I think he realized, oh crap, this could help. This could increase inflation. So then he comes out in this most recent meeting, and is more rigid again. And so the 10-year goes back up. And so it's just crazy how things change so quickly. Perception is controlled by, a handful of these media groups. And we have to now, just as citizens, and especially as investors, we have to really do our own research. And you can't take things at face value anymore. And even as business owners, you and I, Gino, I know you and I have both done this. We have to defend ourselves, and we shouldn't have to do this. But you have these journalists sometimes that are just putting out these BS articles, and we have to go out here and say, no, here's the facts. Okay, if you're going to put something out, look at both sides and the objectivity of it. So that's kind of what my stance is on that. And unfortunately, it's the world we live in, right? And that's just going to continue to. I think that's going to continue to increase in that way.
Zach, as we wrap up, I understand the hard work, the dedication, the perseverance that you put in to be building a business from 0 to 2 billion. It takes a ton of work, a ton of effort. How can the listeners reach out to you? Because I think your story is inspirational for anybody who's young. I'm too young to do this. Well, Zach wasn't in his 60s when he did it. He was in his 20s. I don't have the money. Well, neither did Zach. I don't have the experience. I didn't see Zach's experience or his balance sheet or his credibility. I really want I want you to just reach out to listeners and say, hey, this is where you can learn more about me, learn about my deals. If you want to learn about my story, where can they find you?
Yeah, no, thanks so much, Gino. And yeah, give people an idea. I was like 27 when I started. I'm 32 now, right? So age is not an excuse. You're not too young. You're not too old, right, to make it happen. But yeah, I mean, I'm happy to talk to anybody and kind of give you advice. And I know what it's like, so I don't think that we're like, too big or good to help people. I'm always talking to people to try to give them advice. And so you can go to our website, rise48equity.com, RISE48equity.com, and you can actually set up a call with me. I have my calendar on there, or you can email me, Zach, ZACH, at rise48equity.com, and I'm happy to get on a call and kind of hear what your goals are and help you out however I can.
Brother, I appreciate you getting on. I appreciate you being honest, authentic, transparent. I appreciate the story from 0 to hero. back to beleaguered, back to hero again. And it's really a journey, everybody. I mean, Zach didn't know anything. He probably knows less than when he started because he keeps growing. He keeps adding new teams on. Now he's project management, construction. So I just want to thank you for being on the Jake and Gino show. And you can say you finally arrived. You were a listener, and now you're an amazing guest in the show. So I just want to thank you for being a member, being on the show. And listen, any final words from you, brother?
No, thanks so much, Gino. I mean, it is an honor, man. Honestly, like, it's pretty cool. I looked up to you guys and still do. And it is kind of like full circle for me to kind of be on the show. It's pretty cool, man. So I appreciate you guys having us on, and keep doing what you guys are doing, because you don't know how many people you are impacting, and you guys were an inspiration to me. And so I think just keep doing what you guys are doing. I'm a big fan of you guys.
Zach, I hope to see you at the next multifamily conference. So listen, everybody out there, go out there, make it a make it happen day. Take care, everyone.